now. I bought exactly a year ago, and the units that are selling now don't have a rooftop patio like my unit does, and are a little bit smaller, and they're selling for something like $90,000 more than what I purchased for a year ago.
Yeah.
And
Well,
it's crazy. I mean, you're
it's all
talking
crazy.
in the sixes.
It's all crazy.
It's
It's all
nuts.
crazy.
We're all nuts. Thanks everyone for joining us. That's our conclusion of the day. It's all
It's
crazy,
nuts.
and we're
Yeah.
all crazy right along with it.
Yeah.
Thanks for hopping on. We'll give it just a few minutes here, and then we will get going.
I'll get my Stanley. I'm one of the crazy people with the lead infused cup.
I think we're gonna have some treats similar to that soon.
Yeah.
Yeah,
I love mine. I mean, it's heavy, but
they are nice though.
they are nice. Yeah. But I mean, the chances of that plug coming out of there, and I don't know. It's kind of like the chances of an FHA house having the paint chips eaten by the children. It's like, could we really get off of this bandwagon? Really? Could we please address lead-based paint? Please.
Oh, goodness. Good morning, Justin. Teresa might are well, she's not coastal though. We're both Midwestern girls. So anybody on here on the East Coast, we'll let them argue with you in the chat on which is the best coast. So I think we'll get going here with that. Thanks everybody for joining us. This is the last week in mortgage today. Midwest coasts are the best. I'm not going to get in the middle of that
Great
argument.
Lakes.
That's like, yeah, that's like something that could end up being bad for me in all from all angles. But so lucky today. I have someone who I consider a good friend that I've known for a long period of time, Teresa
Yeah.
Rose, who is the president of Western Ohio Mortgage, with me today. I was so excited today. I was telling Teresa before we already had a conversation long before we hopped on here that we should have probably just recorded and shared with you guys as well. We were talking about all of the things, which we will continue to talk about all of the things going on there out in the world. And I said, I was so excited when I saw that Teresa was the person that was on here with me this week after all of these things were announced, because I knew she would be willing to share.
Fired up. Fired up. For sure.
Share how she feels about them. But
Yep.
Teresa, do you want to share just a little bit about Western Ohio Mortgage?
So yes, thanks for asking. We are celebrating our 25th year. It was official.
Congratulations.
Thank you. The February 1st was official of when we incorporated Western Ohio. I've been doing this for 40 years, but I was with a bank before, and I had a brokerage for a short period of time, and then went banker in 99 or postal, if you want to call it that. We went banker in 99. And so we're celebrating that. And we've always been primarily a Govy focused shop, but of course that's kind of changed because we talked about that a little bit earlier with so many more people or so many more realtors really wanting to focus on conventional cash offers. It's been a little bit of a challenge, but that's always been our bread and butter and really what we specialize in and what we do best. And so we're looking forward to just keeping focused on that moving forward and not forgetting, where we started, how we started, and where we will continue to be, I believe, in the years to come. So,
Yep. Yep. Fantastic. You've always run a great business there and a great women-owned business when there weren't a lot of them out there. So we're always proud of you here. Much congratulations for your 25th for sure.
thanks.
Let's just get started. Let's start a little bit like where we started when we just hopped on the phone and started talking with each other.
Mhm.
Obviously, it was a State of the Union this week.
Yeah.
And there are all kinds of things that were thrown out there in that. And we were trying to calculate the numbers. So anybody on here, please chat with us today. We would love to hear your opinions, your analysis of the numbers, and everything if you have them. So please hop into the chat and join us. But yeah, middle class first time home buyers. $5,000 per year for 2 years.
Yeah.
One of the things that was thrown out there.
Right. So if you do the math, and as we talk through all these things that are thrown out there, and you start adding millions after millions after millions after millions, of course, the first question becomes, who's paying for this? Because it's a lot of dollars. So, on one side, when you hear them talk about, hey, let's give some mortgage relief to middle class home buyers, you're thinking that's great. Let's do it. Let's give them an opportunity to make this a little more affordable. However, the way it's proposed, of course, it's not like an MCC credit. Those of us who use MCCs, where it is calculated into the payment as a savings that will actually go into the qualifying, right? So if you're getting a tax credit that doesn't really help you qualify, other than make you feel a little bit better about your mortgage payment, it doesn't really help us get more buyers in, number one. The other part of the problem is the unintended consequence, and that is, we all know that once you enable more buyers to the market, it exacerbates the problem we already have in the fact that we already have a low inventory issue. So trying to support this problem by going on the buyer side, when really it feels more like we should have been looking at incentivizing sellers, it just didn't make a whole lot of sense to me that you would do it this way. Like I said, at the surface, it always sounds great. Yeah, $400 tax credit a year for whatever it comes out to be, 420 or whatever it comes out to be. That sounds great, and we're all for that if it works. And in this particular economics of housing, I don't see that it does.
Yeah, I mean, there was the other thing that was thrown out there too. The 1 year credit of up to $10,000 for families who sell their starter homes, as long as their houses are below the median price in the county. So
Right.
I'm not sure how many, that like throws out of the mix, starter homes that are below the median price in the county. But so it's like another thing. When I looked at this, I kept thinking, there's a missing component here.
Mm-hmm.
That where's the incentive for companies who own those investment properties, or that own a lot, people that own a large number of properties? Where's the component in here that gives them some sort of incentive that actually frees up housing for people to buy?
Right, right. Because I think that you could definitely get more sellers to move. And again, we're primarily talking single family. I know there's some conversation of, well, it should be 1 to 4. Well, maybe. But I think particularly single family, because of affordability, for one thing,
Yeah.
that's going to be the big piece of it. But there had been talk, and I saw the line here where it talked about the $10,000 tax credit for middle class families who sell their starter home. And I'm thinking, okay, so how are we defining this? So we're assuming it's a starter home. We have to go to every market. We have to set a dollar amount of how much that's going to be. And the estimate was it's supposed to help like 3 million families. I don't know where they got that number. But again, if you aren't doing, this $10,000 tax credit is great, but if it's not defined a little better than what they have here, and maybe I'm just missing something, I don't know how it's effective and how you administer it. We all know, first of all, I digress, but the odds that this all gets passed this year before the election, that's zero chance, right?
That's the other thing.
So zero chance any of this happens this year, because first of all, if the Republicans are going to probably hold it up for obvious reasons, and then the Democrats are going to say, see, we wanted to give you all of this, but we couldn't because those Republicans
Yeah.
wouldn't let us. You know how they're always fighting against each other. So none of this is going to happen anyway. It's kind of a moot point, I suppose. But just talking about where their heads are when they're putting it together, I think is definitely a relevant conversation. Because the other thing, and this is a little off topic, if you listen to the State of the Union, not just about the housing, but their tax plans for corporations, for billionaires, right? Nowhere in the State of the Union address did I hear anything about, here's where we're going to make cuts in our budget. Here's where we are going to, doing what every American family has had to do. And that is, we're going to tighten our belts here. We're going to do without this. We're going to cut that. Because American families can't just miraculously increase their revenue. But the government's idea is, oh, forget about cutting those nasty expenses. We're going to go another direction to increase revenue. And that's what I got out of it. So I don't know if they're thinking they're going to pay for all of this with the new taxes that they think that they're going to bring to the table, or how they plan to pay for it. But that was the other thing I took away from that address was, you're talking about housing here, but you're still dodging the underlying problems that we have of cutting the federal budget, which isn't even on their radar. It's not even on anybody's radar.
Yeah.
And then the other piece of this down payment assistance, and I did the math on that, and I think it's 10 billion, is this $25,000 in down payment assistance to first generation home buyers, which
Yeah.
I'm going to say is primarily going to be minority borrowers, which
You would think.
definitely needs something to help to uplift minority borrowers, because we've been having this conversation forever. And we seem to be in the same place. We don't seem to really be getting anywhere. But that's if everybody got 25,000 in down payment assistance, and if there were 400,000 families, which seems to be the magic number in all their proposals, it's
It
400,000.
does. Yeah.
It is a magic number. That's, I think, $10 billion. I don't know where in the budget that might be coming from, but do we need some side of assistance available? It's a great idea. Does it need to be $25,000 down? Probably not. Because we have this great thing called the Federal Housing Administration. It's a 3.5% down payment program, right? That we aren't using, in my opinion, the way it could be used. There are so many ways through FHA that we could get people into homes. You aren't going to need 25,000 down. You could potentially do a government gift or grant in order for them to get into those homes. So there's definitely a way to skin that cat with something we already have, instead of having to reinvent the wheel with a new tax credit. And I know at the collaborative, I think we're going to be talking to I'm sorry,
Julia Gordon and Sandra
Julia
Thompson.
Gordon. Thank you.
Yep. Yep.
About FHA, and I don't know what all topics are going to be discussed, but I think there's still some room for a little overhaul over there, because like I said, I've been doing FHA loans forever, and I see that in 2008, when we had the financial crisis, FHA became 40% of the market. We're not trying to go back to 40%, but it proved a point, and that was that the Federal Housing Administration is supposed to be there for times of crisis, for times of difficulty in housing. They're not supposed to be the primary place you go for financing.
Mhm.
But in my opinion, right now, we're kind of in that place.
We are. Yeah.
But we're there, and we need them to step up and do what they're chartered for, to help our first-time buyers and our first-generation home buyers get into housing. So there are other ways that we can get them in by using what we already have, and not necessarily having to give away $10 billion.
Yeah. Yeah. I think, obviously it was a State of the Union. So maybe because it was a State of the Union, you don't bring up things like cuts or, changing things, because that would not be seen as positive. And then I also, I try not to think this way. I try not to be a pessimist about things, but I'm just I'm not a hugely political person, but I hate the fact that people can't get along with each other. That really, really bothers me, that your purpose is to negotiate things, but not necessarily be divided. That's how I see the world. That's my opinion, not TMC's opinion, not anybody else's. That's my opinion.
I'm with you.
But it's like, so were things brought up is part of a campaign type thing versus something that truly was well thought out and was realistic and was really thought that it would be helpful, and then just kind of missed the boat.
Yeah.
On things. And I try not to be that pessimistic person, but at the same time, that's kind of where my head went. It's like, well, were all of these things brought up and proposed and said they were going to be done because they know they're not going to be accomplished, I guess, or do they really think that it is something that can be done, and we maybe just missed the mark on what the best way to go about it is?
Right. Well, another thing, when we're talking about FHA, one of the things he did bring up in his speech, he mentioned HUD.
Mhm.
He did mention FHA, and talked about the fact that they had reduced, the mortgage insurance premium. It saved, I don't know,
Yep.
$800 a year, right? So
Yep.
on that bullet, then they start talking about lowering costs for refis. And you know, it makes sense, honestly, to me, to be able to do something as far as not having to have a lender's policy on a refi.
Mhm.
That makes sense. Because a reissue rate on title insurance is still like 70%, and it's kind of expensive, and it is probably a cost that could be eliminated. But then he goes on to talk about, having the CFPB take a look at some of the other costs associated with the mortgage. And to quote it, just basically says that the charges are being, the benefit of the lender and not the borrower. Well, then the CFPB needs to reduce the cost of compliance, because, we all know, we all know that's not the case. That money's being used to pay the overhead to make sure everybody's, nobody's committing fraud, and our underwriting is being done the way it's supposed to. So we can check the checker and check the checker's checker and do all that. That's all expensive.
Yes.
So I thought that missed the mark a tad. But I think that maybe lowering, or reducing the requirement, for lenders policy would probably be not a bad idea. I don't want to hurt our friends in the title business, but at the same time, that is an area where we could probably save some money.
Yeah, Derek posted comments in the chat that said they need to go down the rabbit hole of the lender's costs, such as credit,
Oh
etc.
my gosh.
Yeah,
Yeah.
which is a
Yeah.
whole other topic that
Very sore subject. Yeah.
yeah, yeah. And Aaron D, I love you to death as always. The price of listings when we were talking about the $425, she said the price of all listings just went up by $400 immediately. Ha ha
Right.
ha.
Yeah. Yeah.
Because
Yeah.
that also tends to happen. So yeah, so there's a lot. I mean, just a lot of things out there to be watching and
Mhm.
kind of seeing. I'm sure we'll talk about them again on here, kind of seeing what happens with that. In addition to that, fourth quarter 2023 household debt reached a new high, continues to keep rising of $17.5 trillion.
Yeah. Ouch. Ouch.
Yeah, yeah.
Actually, I think we just got the report for credit card delinquencies up, I think last month, up to 3.1%. It's inching up, the number of credit cards that are delinquent. It is, for those of us who were here in 2008, that's a scary thing. Okay, because we saw this movie, we know how it ends. So for those of you maybe who weren't here in 2008, congratulations, because it was scary. But people we know, 2003, 4, 5, they were using their houses for piggy banks. They were running up crazy credit card debts, and that's, oh well, I'll refi. My broker said I could just refi this later, pay it off, and start all over again, because the houses just keep going up and up and up. And we know that as a result of that kind of churn and burn, that we got to a point where it finally burst. And so, the again, unintended consequence of tapping into the equity is that when the rubber finally does meet the road and the borrower can't afford the payments anymore, now you have this roll of foreclosures, which is another, I mean, that has affected our inventory really and truly in the last several years. Foreclosures have been down. That's probably going to start going the other way, right? Because as things become more and more unaffordable, we're going to see some of that inventory unfortunately come to the market. But to see that level of delinquency and the amount of credit card debt, because we went through a time, I'm going to say like from 2010 to maybe 2016, where people were seeming to be a little more responsible with their money. They were saving more money.
Mhm.
They weren't running their credit cards up. Now we have found out that, I think COVID did a lot of that. We can blame a lot of it on COVID. We saw that pent up energy of, I want to spend, spend, spend. And then when they started spending, they couldn't stop. And so now they're using credit cards to support a lifestyle. And then they'll turn to their home's equity to continue supporting that that lifestyle until potentially they get to the point where they have no option to refinance. So
I do think there is, I do think there is some of that. And of course I did live through 2008 too. I worked in the broker subprime area. I think, I had 8 brokers all in one building that went under in the exact same week, out in California. So I was in that space then, and I remember dramatically the whole implodometer and those types of things.
yeah.
But I look at 2008 and now maybe a little bit differently. And I think that some of those things were self-induced by the mortgage industry. We had a lot of people that are no longer in the industry, and maybe shouldn't have been in the industry. And I don't feel like we have that same thing going on in the mortgage space anymore.
Yeah, it's not the same. It's not the same. However, it's not. You're correct, because what we see, because there have been so many parallels maybe between 2008, but this is the same, and that is the fact that at that time people were using credit cards and home equity to support a lifestyle.
Yep. I wonder though if now though part of it isn't as much. Part of it is true. And I did see a lot of people do that after COVID because they were so sick of being cooped up at home. And now I'm going to take the 4 vacations that I missed and all of those things. But I wonder if some of it is based out of necessity as well, with the cost of everything that has went up. Groceries. I mean, it just pains me to go to the grocery store every week. I'm sure, and I'm me and one other adult child that's with me half the time. It makes me wonder how families are surviving and whether right now they're using credit cards as a way to sustain what we would all consider a pretty normal lifestyle.
Right. Absolutely. Yeah. I don't mean to infer that people are just using it because they want to travel to Europe or do that, but a lot of them are absolutely doing it just to get by, that, to pay for gas. Some of them are probably putting utilities on credit cards. I mean, anything, because a lot of time I think that there's a false hope that it's temporary, right? Hey, maybe somebody in the household lost their job, or, yeah, prices are up right now, but it's temporary. We can still get by. We can still have, steak and chicken breast for dinner. We don't need mac and cheese yet. And then you kind of get to, well, gosh, I got to keep rolling with this. Now I'm to a point where, I am eating mac and cheese and I'm still putting it on my credit card. So there's definitely truth in that statement. Yes. I don't mean to infer that that's it. There was a lot more of the excessive lifestyle going on in 2008 for sure. But yeah, it is troubling because we don't want to return to a place where people are really kind of forced to use their house as their piggy bank to pay off, because that debt, I mean, come on, everybody knows it's 25% interest or some crazy number that you can never pay off, which is why they required them now to put the thing on the credit card statement that tells you, okay, if you keep this,
how long it will take.
It's going to take. You're going to be 96 before you pay this thing off, right? That's why it's required, because people need that reality in the face. They don't fully understand it, and we just don't have a lot of financial literacy, in the sense that we don't spend enough time in schools teaching people about the dangers of credit card debt and how to use a credit card responsibly, how to responsibly build credit, which is, one of the problems that we have in our minority population, them not having the ability to get that first credit card or get that first installment debt at an interest rate they can afford, so that they can start to build credit and then get into housing. And that's part of the problem that we have with, the conversation we had earlier, is how do we get more of those underserved borrowers into homes, let alone the fact that we have the low inventory and that we have corporate enterprises going out and buying up their neighborhoods. We haven't even addressed that nor talked about that yet on this call. And that's another huge problem that we have.
And then Aaron pointed out as well, student loans coming due. So student loan debt also, at a peak for people that I'm sure for, some younger people, I'm sure student loans is what makes them not have the ability, not only to not save, but to purchase a home, save to have a down payment, purchase a home, or even maybe qualify,
right?
Depending upon the amount of student debt that they have. Well, I saw something that you just kind of led us into. So I think I'll go down that path. So Kirk Willison from Arch MI is a good friend. He's somebody that I religiously read the things that he writes because they're usually very thought provoking. So Kirk, if you're listening to this, love what you do and what you put out there. He had an article out there this week, as well as a video or a movie, a small movie that he had put out there that I did take the chance to watch and listen to, and it was all about the inequity in housing. In this instance, it was first time home buyer. Well, it wasn't first time home buyers. It was a racial segregation in Little Rock, really, if you want to be honest about what it was. And it was just very interesting to me. I read his article. More than 24% of Black families who applied for home purchase in 2022 were denied. 11% of white applicants. It's more than double. More than double. It speaks to some of the things that you just spoke of. It's like, are we helping the right people? Financial literacy is so important. And how did people get to that? Well, it went on. I ended up, and the inequity is compounded by the housing shortage, higher interest rates, all of those types of things. So in this article, and I would recommend that everybody go out and find this. It was a documentary done by the New Yorker. And if you listen to anything that I have to say, this is one of the things you should listen to. There's a documentary out there. It's called The Barber of Little Rock. It is 32 minutes long, so it will not take up a lot of your time. But you should go out and find it and listen to it, because it may give you a completely different perspective of things related to the inequality that is out there. So here are just a couple of the things that I took out of this. So Little Rock, a little geography lesson, is divided by Interstate 630. And it literally divides the town into different communities. On one side of that is a community of 30,000 people. That community of 30,000 people is a predominantly Black neighborhood. That community of 30,000 people, until not so long ago, did not have a bank in it. 30,000 people without a bank in your community. On the other side of 630 is 8,000 community members. Not part of that other community. So I'll just think about it that way. They had 14 banks for 8,000 people and 30,000 people with no banks.
And you just wonder, in 2024, how is this still going on? It just boggles your mind.
It does, doesn't it?
It does.
And it's not, I don't remember when this was done. It might have been a few years ago, but there is a gentleman by the name of Arlo Washington who founded Washington Barber College on the 30,000 person side of the interstate. And he ended up not only opening up this barber school to teach younger individuals and give them a trade and teach them business lessons around how they can make a living for themselves, but he also created the only Black-owned CDFI in Arkansas and started lending money to people that were creating jobs by starting their own businesses and everything. And so this documentary was part of Kirk's article. So if you can find Kirk Willison out there, you'll find it within there. But it made me look at things a little bit differently. So then I went back and read the article again. Black Americans capture only about 38 cents of every dollar of new household wealth. But Black Americans represent 13% of the United States population.
Yeah, I do think the financial literacy is a huge part that we're missing. And it's across the board. It's not just in minorities, but primarily in minority
Mhm.
groups. And then there's one other thing that I think as lenders that we should look at, because if all things are equal, we're like, okay, we see that the problem here is either financial literacy or the fact that credit has not been easy for that sector as
It's not available.
right.
I
It's not
mean,
there. There's not even a bank in your community, right?
right.
So if you're unable to get those traditional forms of credit, or possibly you have dings in your credit because of those circumstances where you had to pay more for your car than a white neighborhood might have to pay for theirs, we can do something about that in underwriting. It can be done. I am a big proponent of manual underwriting. I know the conventional side you can't do it, but in Govy you certainly can. Because if you manually underwrite a loan, you really can see the characteristics that make a borrower, sometimes with a lower credit score, a better risk than a higher credit score. Because sometimes what we're seeing with higher credit scores, they're made up of student loans they've never paid on and a couple credit cards, and that's it. And then we'll see someone that we've manually underwritten that's been in the trenches. They're paying a car payment, they're paying rent every month. They're working hard, but they've had a couple bumps in the road that gave them a score that just won't pass the muster. And so if we are able to utilize manual underwriting to its full potential, we can help some of those borrowers. It's just not being done. So that's how I feel about that.
And that is very much how this gentleman worked within the CDFI that they created. It wasn't large loans that people were looking for. It was much smaller things. As a matter of fact, I think at one point they talked about it was $500 that then was paid back, how it was supposed to be paid back. And then another $500 2 months later that was paid back how it needed to be back. And it was the more of the helping people build capital. And I think that financial literacy is needed everywhere, to be
It
perfectly
is.
honest with
It
you.
is. It
It's
is.
like it's like some of us were taught that, when we were a lot younger, but I don't believe like it's taught the same. I see a resurgence of it, I guess I would say. There are many people that are focused on that and helping people learn that. You see schools beginning to talk a little bit more about some of those lifestyle things that people need to learn. It used to be that you learned that at home. And I
Mm-hmm.
don't think the environment anymore in some places, you know, some younger people don't have that home life that affords them the luxury of having somebody that is going to teach them that in
Yeah.
their
Yeah, I
home.
remember growing up in my house, it was my dad was anti-credit cards and
Mine
he
was too.
preached it. I mean, it was all you ever talk about. Oh, credit cards is if you ever get a credit card, you'll just be in debt for your whole life and you'll never be able to pay. And he was just he rarely borrowed money. He was very much a cash guy. And occasionally would borrow money, but it was very, very rarely. In fact, he never owned a new car his entire life. Never, never, ever. Um, when I was a kid, I think he taped our cars together. But as we
They
got
can fix
older,
everything.
yeah. So he was a shade tree mechanic, and he just fixed all the stuff, right? So that's just kind of how we were raised. But I would agree that today's family dynamic is a lot different
It is.
because today's families have gotten kind of used to fairly easy, accessible credit. But everybody, it's all over the news. It's all over the television. Oh, hey, don't pay today, pay tomorrow. Or, if you need to put a roof on your house, we can stretch it out for 15 years and, pay $99 a month. So I think that because that's kind of the messages that we've always gotten, and because we are in an instant gratification society where we just click it on our
Mhm.
phone, it's delivered to our doorstep, that it's a little different
It is.
situation. And
It
and
is
people can easily get lured into that debt, right? Because you just click and it's
the
there.
wrong kind.
It's there. Yeah,
Yeah.
right.
Yeah, the wrong kind. I did. My dad was also a no credit card type of person, and I don't necessarily believe that. I mean, that isn't how I taught my child. Um, but I think it's like, how do you use credit in the right way that it helps you build
Mhm.
wealth for your
Right,
family? And so
right.
there's certain instances where it should be used, and it should be used in a responsible responsible manner. So I feel like that's kind of where we're missing the boat. We're over time. I mean, we said at the
I
beginning of
told
the
you we could talk for like 3 hours probably today.
yeah. Um, Thank you. Thank you everybody for joining us today. There's been some really great comments that are posted, posted in the comments too about what other people have experienced. Appreciate you all doing that. I'm sure we will be talking about many of these things in the weeks and months and maybe even year to come after the election's over. I'm sure many of these types of things will crop up again. But yeah, definitely recommend going out and finding the New Yorker documentary, The Barber of Little Rock. Everybody should take a listen. It might give you a little bit different viewpoint on things than what you've had in the past. Teresa, you are always a pleasure. I always love it when you come on here. I cannot wait to see you. I will be seeing you
Yes.
in just a couple weeks
Yes. Yep.
in Louisville for
Yep.
our conference, where we will be talking about things like DPA programs and some of those other types of things. So appreciate you so much. Thank you so much for joining me today. And let us know what we can do for you, everyone.
Thanks, everyone.
See you next week.